Hello students, welcome to the series on marketing and retail business. Today we are going to study retail management. In this we will cover unit 4 and we will study VAT and GST in retailing. Now let us study the objective of the study. The basic objective of this study is to do an analysis of VAT in India and to do the analysis also of the introduction of GST in India to abolish VAT in near future. Now, let us study value added tax, that is VAT. A value added tax VAT is a type of consumption tax that is placed on a product whenever value is added at a stage of production and at final sale. The amount of VAT that the user pays is the cost of product less any cost of materials used in product that have been already taxed. Now, VAT is prevalent in most of the countries all over the global world. VAT has been a way of existence for many years. The sales tax was abolished by VAT, and this was a system of uh, putting a price on the most of the products available in the retail sector. VAT was to add tax at each stage of production, and the tax was minused for already the goods which had been uh, taxed earlier. So, this was whatever new value you were adding to each stage of movement of the product, it had to be taxed. That is, it was moving from manufacturers to the dealers to the retailers. So, at each stage some service value is added, and this service value would carry particular segment of the tax. So, this is the present system in India, but the VAT has been still under the scrutiny, and the government is trying to update the system by switching over to GST, which we will discuss in a detailed lecture. Now, let us study the concept of VAT in detail. First is, let us study a natural product which relates to the mining or the agriculture, and suppose the cost is rupees 1000. This goes to the manufacturer and he adds a value of 1000 rupees, that is the product cost becomes 2000 rupees. This goes to the wholesaler where the value is added again of 3000 and the cost goes to 3000. Then it goes to the retailer, value added is 1000 and the cost becomes 4000. So, the consumer cost becomes 5000, that is at each level you have added the value. So, this with each level you have to add the tax. So, 10% of 1000 at each level will be 100 rupees. So, total, that is you have crossed 3 stages, you have crossed 4 stages, that is 1, 2, 3, 4. So, the 4 stages will be somewhere around about 400. So, 400 will be the tax which the consumer has to pay. Now, let us study the methods of calculating VAT. There are two main methods of calculating VAT. One is the credit invoice or invoice based credit method. Other is the subtraction or the accounts based method. What is credit invoice method? Sales transactions are taxed with consumer informed of VAT on transaction. Business may receive a credit for VAT paid on input materials and services. The credit invoice method is the mostly widely used employed method, but all the national countries use it, but except for the VAT is this method is not applicable in Japan. This is the transaction, that is credit invoice method is invoice is known as the bill. So, with each billing which is transferred, that is you exchange within the transaction from manufacturer to dealer, is you have a kind of a credit given for each invoice, and with each invoice the tax is added. Then is the subtraction based method. At the end of reporting period, a business calculates value of all taxable sales, then subtracts the sum of all taxable purchases and the VAT rate is applied to the difference. The subtraction method VAT is currently only used by Japan. So, this is a difficult method and only one country like Japan is residing on it, where you try to calculate the value of all the items which are added to the final production, and you try to minus the value which has been taxed. So, the difference which you get, that is the value which is left, has to be taxed. So, this is the subtraction of the taxable items from the whole value of the product, which is the end user, that is who is using the product. Now, let us study the methods of collection of for VAT. This is the method for collection of VAT, can be account based or invoice based. Invoice based method for collection of VAT. Each seller charges VAT rate on his output and passes the buyer a special invoice that indicates the amount of tax charged. Buyers who are subject to VAT on their own sales, that is the output tax, consider the tax on the purchase invoices as input tax and can deduct the sum from their own VAT liability. The difference between output tax and input tax is to be paid to the government. Now, wherever you are generally buying your goods from a retail sector, you would see that first the final billing of all the goods is done, and then the extra charge which is shown in the bill is known as the VAT. This is the sum of the amount which they have calculated on the input, that is whatever items they have, and this value which they get is basically kind of the total addition to the tax. Now, what they are going to pay to the government will be the difference between the output and the input. This will be the value which you will get at the end. Now, let us study the accounts based method. No such specific invoice are used. Instead, the tax is calculated on the value added. It is measured as a difference between revenues and allowable purchases. Most countries today use the invoice method, the only exception being Japan, which uses the accounts method. The accounts based method basically is not using the invoices, but the accounts are seen, and the value which is added at each stage has to be taxed. Now, let us see the registration for VAT. In general, countries that have a VAT system require businesses to be registered for VAT purposes. VAT registration businesses can be natural persons or legal entities. Businesses that are VAT registered are obliged to include VAT on goods and services that they supply to the other. To take VAT from people, you need to be registered as a business entity. Business entity could be organization or can be a person who is giving consultancy or services to people. And now when you are registered, then only you can charge the tax from people and then pass on to the government. Now, let us study the types of VAT. You have income type, product type and consumption type. Now, let us study the income type of VAT. This is sales minus raw material purchase and depreciation. Product type is sales minus raw material purchase and there is no deduction for capital expenditure. Consumption is sales minus raw material and capital good purchase. So, in income type obviously the sales minus raw material and depreciation, product type obviously the sales minus raw material, and here the capital expenditure is not deducted, but in consumption you have sales minus raw material with capital goods purchased is also included. So, these are the basic types of the VAT which we use for calculating the tax in the retail sector. Now, let us study the basic principles of VAT. The principle of origin taxes the value added and results in exempting imports, that is taxing of exports. This is considers the origin as the base for taxing. Destination principle is this tax adds all addition in value either domestically or abroad. It results in taxing imports and exempting exports. Goods consumed by consumers of state to be taxed by the state. Now, what is the origin principle? That is where the good originated, and here is the point where you have to give tax to the government. What is the destination principle is where the goods are reaching, that is if you are doing an interstate transaction and if these goods reach to the other state, the other government will also charge you the tax. Most of the exports are exempted from VAT, but most of the imports have to be levied by this structure. Now, let us study the methods of VAT implementation. One is the subtraction method and other is the tax credit method. Subtraction method is tax on value added by deducting purchase from sales. Tax credit method is tax levied on full sales price, but credit is given of tax paid on purchase. So, subtraction method is obviously you deduct the value from the that is uh, you have to tax on the value added. What is the each final stage of production has to be taken into consideration, and this is the only segment on which you have to apply the tax. Now, we have studied VAT in details, but recently the government is doing an analysis and trying to abolish VAT and try to update their systems on GST. GST in near future is the modern method which will impact the public life as they will purchase the goods and services from the retail sectors. So, I will give you a little bit introduction of GST also, so that the students have a impact in terms of learning to be upgraded to understand what is the tax structure available in India. Let us study the goods and service tax, that is GST. Goods and service tax GST is a proposed system of indirect taxation in India, merging most of the existing taxes into a single system of taxation. It was introduced as the Constitution 101st Amendment Act of 2016. So, this is already in the final shape and has been discussed at various phases. This is trying to merge all the value added tax at each stages of production and at each stages of movement of goods and services, and is trying to look after the problems of interstate exchange of taxes, and also trying to give one figure to the consumer, so that he is not cheated in terms to pay duplicate taxes separately to central government and to state governments. So, they have coordinated with each other to design an updated system of GST which will benefit the consumers in long run. Now, let us study the chairman of GST Council. The chairman of GST Council is the Union Finance Minister, who is Arun Jaitley presently. So, GST now is a part and parcel which is being propounded to the public by the Finance Minister of India. GST as indirect tax. GST would be a comprehensive indirect tax on manufacture, sale and consumption of goods and services throughout India. It replaces tax levied by central and state government. So, this would be a comprehensive and a single tax structure which will be imposed on the manufacturer, and this would also eliminate the separate taxes on same products by the state and the central governments. GST as a consumption based tax. The GST is consumption based tax levied on the supply of goods and services. It would be levied and collected at each stage of sale or purchase of goods or services based on input tax credit method. So, here the value is not calculated, but as you move through each cycle of the delivery of the products, you need to design this tax structure. GST registration. This method allows GST registered businesses to claim tax credit to the value of GST they paid on the purchase of goods or services as part of their normal commercial activity. So, if you are a business firm, as a part of your normal commercial existence, you have to register on GST portal. Taxable goods and services are not distinguished from one another and are taxed at a single rate in a supply chain till the goods and services reach the consumer. Administrative responsibility would generally rest with the single authority to levy tax on goods and services. So, there is a single rate employing the supply chain till it reaches the consumers. The authority will be sole authority, single authority, who will judge what will be the tax on each segment. GST and exports. Export would be considered as zero rated supply. Imports would be levied the same taxes as domestic goods and services, adhering to the destination principle in adoption to customs duty, which will not be subassumed in the GST. So, when you talk about exports, that is, it is a zero rated supply, but in terms of imports they are considered same as domestic goods, and the same tax structure of GST will apply to the destination where the goods are being used or where the goods are being imported. So, this will be the destination based structure of tax. Now, introduction of GST. The introduction of goods and service GST would be amalgamating several central and state government taxes into a single tax system. This would mitigate cascading or double taxation, facilitating a common national market. The simplicity of the tax would lead to easy administration and enforcement. So, a single tax structure all over one national market will solve many problems for the consumers and for the government. Advantages from consumer point of view. reduction in overall tax burden on goods, which is currently estimated to be 20 to 30%. It will allow free movement of goods from one state to another. There will be no stopping at state borders for hours for payment of state tax or entry tax. There will be reduction in paperwork to a larger extent. Now, GST will be paid on a software allotted method, that is, you will have computers and terminals connected, where online allocation to each businessman will be done in a way where they could easily understand the portal and could easily do their billings in such a way that the tax is paid to one national market. That is, if you are moving even from one state to another, you do not have to be responsible for separate governments. One national market will be created, which will allow easy movement of goods from one destination to another and with no paperwork. Advantages of GST launch in India. The tax rate under GST may be nominal or zero rated for the time being. It has been proposed to insulate the revenues of state from impact of GST, with the expectation that in due course GST will be levied on petroleum and petroleum products. The central government has assured the states of compensation for any revenue loss incurred by them from the date of introduction of GST for a period of 5 years. Now, when you launch this tax structure, obviously the state governments will be in a shock, because the most of the revenues from double taxation or from multiple taxations will be lost. So, the central government has assured them that till 5 years they will give subsidies to state government to stabilize and adopt the structure, because if the taxes are low, obviously people will buy more goods, and as the turnovers will increase, this will increase the business activity, and this would benefit the state governments in the long term. As India is a federal republic, GST would be implemented concurrently by central and state government. Now, let us study first the existing structure in India. The tax structure in India is the direct tax and the indirect tax. The direct tax is the income tax, the wealth tax, and the indirect tax is taken by the central government and the state government. The central tax is the excise, service, and it is the custom tax. The state tax is the VAT and the entry tax and the basic tax related to luxury and other taxes. Now, let us study the proposed tax under GST. We have the tax structure, that is again the direct tax and the indirect tax. The indirect tax would have a component of GST except for the customs. So, the direct tax is obviously the income tax and the wealth tax, but the indirect tax will have a intrastate and interstate regulations. The intrastate regulations would be impacted by the GST, that is the central tax, and the SGST, that is the state tax, and the interstate tax will be related to IGST, that is the central tax. So, this is the total structure where you relate to the direct and the indirect taxation in India, and GST will always be a part of indirect taxation, what the consumers have to pay to the government through the retailers. Direct tax is what the consumers are paying directly to the government on their income and on their property. Now, let us study the sub-assuming of existing taxes in CGST, that is the central goods and service tax. This is the central excise, service tax, additional duties of custom, CVD, and the surcharges and all the cesses. So, when you talk about the central level taxation in terms of the existing tax, it would be the excise and the service tax and the surcharge which you pay as a SAS to all the services which you used, which are given by the government. Then is what is the SGCT, that is the state GST would include the sales tax or the VAT, which had been already a part of your existence. It would also accumulate the entertainment tax, the luxury, the lottery tax, the entry tax, the purchase tax, the stamp duty, goods and passenger tax, tax on vehicle, electricity, banking and real estate. So, this was the state level portfolio which was being taken by the government as a part of your collection through VAT and sales tax, but now this will be replaced by GST, which would incorporate all the values associated with these kinds of the taxes. So, the stakeholders of GST which will be impacted by this will be the states, and the goods and service tax would be the manufacturers, the wholesalers, retailers, consumers, the governments and the banks. So, the whole community of business will be impacted by GST. We are abolishing VAT and we are moving to GST, but the stakeholders need to be aware, they need to be concerned, and they need to be committed to make this successful, because the businessman, the manufacturers, the consumers and the banks and the government all need to connect to this software so as to make this system a successful in India. Now, let us study the summary of this lecture. We have studied VAT and GST in retailing. VAT had been the existing structure of taxation in India, and it is basically a kind of a successful structure imposed by many governments all over the world. There is some difference in the American and the European and the Japanese economy, but the structure is followed the same all over the global economy. But now we are moving to the GST, that is the goods and service tax, because the interstate communication is becoming difficult and the consumers are hard hit by the double taxation and the multiple taxation at each stage. So, the central government and the state governments have coordinated and designed the GST, where you have to pay the taxes in retailing through the indirect component of tax as a factor given to the government. I hope the students must have understood GST in details and why VAT has been abolished in India. Thank you, students.